Well, good morning, and it's finally here. The end of the month and the end of the second quarter. It could not come fast enough. All I can say is good riddance to what was a very difficult quarter and difficult first 6 months of the year. So what is it that you need to know, right? Stocks are under pressure again on this last day of the month in the quarter. JJ promising some pain as rates move up and he targets inflation. And more Fed members are hinting of at least a 75 basis point move. The PCE deflator came out at 8:30, and it actually showed that it was less than the estimate at 6.3% versus the 6.4% expected. And what are we doing? We're having blueberry pie and ice cream for dessert this 4th of July weekend. Okay, look, yesterday was a non-event. Stocks didn't do much of anything on Wednesday. They finished almost flat. The Dow adding 83 points. The S&P fell 3 points. The NASDAQ lost 4. The Russell gave up 20, and the transports gave back 60. In light of the way it has been trading, that was a relatively benign day. Economic data showed that the final revision of first quarter GDP was in fact weaker than previously thought, coming in at negative 1.6% versus the negative 1.5% estimate. Personal consumption plunging, coming in at 1.8% versus the 3.1% expected. And mortgage apps were positive, but only very slightly by up 0.7%. Investors found it hard to identify any consistent direction yesterday as they parsed through the comments made by the various Fed members. Chair Powell spoke at an ECB conference in Portugal, where he tried to convince the audience that the U.S. economy is in a strong position and is well positioned to withstand tighter monetary policy in the months ahead, all while remaining committed to bringing down inflation, saying that Americans need to accept the fact that his actions could produce a recession risk while they battled inflation, and he did expect that the process would cause some pain. Some pain, I gotta ask, is he joking? Have you seen how much pain and value has been destroyed over the past 6 months because the Fed lost sight of the mandate back in May of 2021? If you don't know, let me tell you, more than $10 trillion of paper wealth has been lost since the start of 2022, and that's just been in the global stock market. If you include the losses in the crypto space, toss in another $2 trillion. Because as if, they talk about trillions now the way we used to talk about millions. I wonder yet, though, have they taken that Matt Damon crypto commercial off the air yet? You know the one, right? You saw it, very dramatic. The one that says the 4 simple words that have been whispered by the intrepid since the time of the Romans. Fortune favors the brave. Remember that commercial? It was all very dramatic. Matt Damon, delivering this speech all about crypto. So how's that working out? Well, it isn't at the moment. Bitcoin is down 74% from its highs that it hit on November 9th of 2021, $70,000. On June 18th, it pierced 20,000, traded as low as 17.7 before rebounding. And this morning it's trading around 19,300. Ethereum has had the same pain, right? It's tumbled from its $4,000 high to fall by 75%. This morning it's trading just about $1,000. $1,000 a coin, right? And so just add in the stupidity over NFTs, and that just only exacerbates the problem. Let's not even go there. But again, some will say you can also say that about the stock market, right? You can point to all the Cathie Wood names and find that they have collapsed by at least that much, if not more. I mean, her position in Robinhood down 90%. Coin down 86%. What about Roku? Down 82%. And if you look at the other names in the ARK ETF, which is off nearly 55%, you'll find even more blood on the streets. Teladoc down 90%. CRISPR down 73%. iPath down 72%. But then again, those are not the stalwarts of the U.S. capital markets. Those are not the names that you would build a foundation on. And if you did, then you probably don't want to open your upcoming quarterly statement because it ain't going to be pretty. Now, after years of strong growth, it is time to pay the piper. The first 6 months of the year have not been good. Stocks have not held up very well. In fact, this is the worst start to the year since 1970. The Dow down 14% year to date. The S&P off 20. The NASDAQ down 29%. The Russell down 24%. And the transports off 20%. But a look at the broad S&P sectors reveals even more information, right? Consumer discretionary, communications, they're both down by better than 30%. Tech, real estate are down by about 26 and 22%. Industrials, financials, and basic materials all down in the high teens. You can point to the utilities and healthcare and consumer staples as the relative outperformers, and that they're only down about 8% on the year. While energy, the XLE, is the outperformer for the year, surging up 32% on the year in the face of all that other disaster. Stocks being beaten up by the boom-bust cycle. You know, the very basic premise of Econ 101. Rising rates and slowing growth that appear in every cycle, which is why they call it a cycle. The rapid increase in global inflation, coupled with the remnants of a global lockdown and now a war in Ukraine, are only exacerbating that cycle, and that is weighing on both stocks and bonds. But don't despair. The last time this happened, it was 1979, and boy, did it get ugly. And while I don't want to see it happen again, I am the camp that it very well could. We spent more than 14 years stimulating this economy, artificially keeping rates below where they should have been naturally and pumping more money into the system like a drunken sailor. At some point, it has to end. And that won't happen until the Fed normalizes. And that, my friends, I think is still a ways off, right? Rates need to go higher. And the balance sheet, the $9 trillion balance sheet, needs a haircut, a big haircut. So while that's happening, be prepared for a rough ride as investors bet that the Fed cannot navigate anything remotely considered a soft landing. But in the end, as I've said, this too shall pass, the same way it did by 1982 when rates were really high and they started to cut them in the market. What was born then was the greatest bull market this country and world has ever known. Today is now the final day of the month and the quarter, and stocks are not behaving very well. Futures early this morning, and the markets even now that they're open are down, right? The Dow's down more than 400 points. The S&P's down 60. NASDAQ off closer to 250 points. The Russell's down 25. Recent comments by all these different members of the Fed only accelerating the move lower, right? We heard Dailies, Williams, and now Loretta Mester telling us that they support at least a 75 basis point rate hike in July if conditions remain the same. That's great. But what if conditions get worse? The implication is they would support a 100 basis point hike, an idea that has been floated a couple of times this year, but also one that was most recently floated again by Fed Chair Powell when he appeared on Capitol Hill 2 weeks ago. He needs to get that out into the public square. He needs to have people talking about it so that investors and portfolio managers can consider the option and then make targeted decisions, hoping that the market will do the dirty work ahead of the move in a sell the rumor, buy the news type of event. Eco data today is all about the Fed's favorite inflation read, right? The PCE deflator, the personal consumption expenditures deflator. And it was expected to rise by 6.4 year over year and 0.7% month over month. Both readings that were higher than last month. But in fact, they came in slightly weaker, 6.3 year over year and 0.3% month over month. But like I said yesterday, listen to how they interpret that report. Now, it's not higher, so you don't have to worry about it being the lagging indicator that I thought they were going to tell you. It is lower than what the estimate was, so expect that what you're going to hear today is, look, see, we told you, inflation has peaked and it is moving lower, hoping to stop the bleed. My gut tells me that's still not happening yet, but we can hope, right? And today's action with the market down now could also be the end of the quarter, just the flush at the end of the quarter to clean it out. So I'm not really that nervous about what's happening today, but I'm concerned about the future. The 10-year treasuries rose in price, think the safety trade, and that caused yields to move lower, right? Ending the day yielding 3.08%, down from 3.17% on Wednesday. This morning, treasury prices are up again. Think again, capital preservation, and that's forcing yields lower. Currently, they're yielding about 3.04%. Now, this makes no sense considering that the Fed is telling you to expect an increase in 4 weeks in Fed funds, right? So tread lightly because as rates rise, treasury prices will decline. Fed funds are about to go to 2.5% to 2.75% at the end of July. The 10-year treasuries have to then move higher, probably closer at least to 3.5%, if not a little bit higher. Investors, and if it does go higher, that means investors are pricing in kind of a long and deep recession. Think back to 79, 82. Tomorrow starts the third quarter, and earnings start in 2 weeks. Estimates are being revised lower, and the expectation is that the C-suite is going to warn of tougher times ahead. Second quarter Atlanta Fed GDP estimates that the economy is growing by 0% in the second quarter. Well, thank God. I guess that's better than the negative 1.6% that it was trading at in the first quarter. Traders are ramping up the bet. The bet that the economy will collapse under the weight of the Fed tightening, forcing JJ to blink. Right? Fed fund futures have now done a complete 180 for 2023. They're pricing in a 50 basis point rate cut in 2023. No longer those continued rate increases. So we're going to see, right? Oil is bouncing around, currently trading at $109.65 a barrel. European markets are under greater pressure this morning. They're all down more than 1.5%, with France, Germany, and Italy down more than 2%. The story, nothing new. Inflation is surging, and investors there are concerned that the ECB, the European Central Bank, is way behind the curve and will likely need to change the narrative in order to give the impression that they can arrest inflation versus just letting it burn out at its own pace, which would be really, really ugly, right? Just saying. That's not really what you want to see happen. Okay, so the S&P closed last night at 38.18. The markets, again, are weak today. And if the PC report suggests that inflation is not peaking, then watch as the algos go into overdrive. Now, that's not what happened. So I expect we're going to have this end of the quarter kind of push. And then it should stabilize, I think, going at least into the beginning of the third quarter, right? And listen, as the weakness comes, don't expect buyers to just stand in place and get run over. No. They're going to cancel their inline bids and move lower, which will cause a void in prices and cause markets to be lower, which is exactly what you see happening, right? It's called risk management. You need to stay focused. This is not the time to get rattled. Remember, fortune favors the brave. Continue to put your money to work over time, not all at once. It's called dollar cost averaging and works to your benefit if you stick to the plan. I remain in the camp that says the road ahead is full of potholes, and I expect that we will retest S&P 3600 sooner versus later. I think that's going to happen as we enter earnings season, because I think that's what we're going to see, just what I told you. Okay, so it is 4th of July weekend. It's Friday, and what do we have for dessert? Nothing better than blueberry pie and ice cream for the 4th of July. I mean, come on, does it get any better than that? This is simple to make, and it's so good to eat. But because it's baking, you just can't wing it the way you do when I cook. I'm winging it, right? Baking is more like a science, so you really have to follow the directions and use the proper amounts of ingredients, right? Versus just a twirl of this and a splash of that. Doesn't work that way. So for this, you need 1 box of Pillsbury pie crust, right? It's pre-made. Get it in the dairy section. There's 2 pie crusts in there, and you find it right in the dairy section of your grocery store. You need 3/4 cup of sugar, 1/4 cup of cornstarch, 1/8 teaspoon of allspice, cinnamon, and salt. You need 4 cups of fresh blueberries, 1 tablespoon of butter, 1 egg yolk, and 1 tablespoon of heavy cream. You want to grease a pie dish with butter, then roll out one of the crusts, fit it into the pie dish, leaving enough of an edge to seal against the top layer of the crust once you get it all made. Now, in a big bowl, you want to mix the sugar, the cornstarch, the allspice, cinnamon, and the salt in a large bowl, right? Toss it, mix it. Then add in the blueberries and toss them gently to coat. You don't want to crush the blueberries, so just be gentle. Now pour this whole mixture right into the pie dish that's got the crust in it. And then cut that tablespoon of butter into small pieces and just place it strategically around on the berries. Now, unroll the second pie crust, place it over the top of the pie, and now using your thumb and index fingers, go around the edge, pinching the top crust to the bottom crust, making it look really nice, like a ribbon. You know how that works, right? Just try it after a while, you'll get the hang of it. But it looks like a ribbon all around the pie crust. Now, mix the egg yolk. You're only using the yolk and the heavy cream. Mix it, whip it up. Now using a pastry brush, brush the egg wash on the top crust. Sprinkle a little bit more sugar on top of that. And then using a fork, go around and just poke holes in very gently into the crust, right? So that the steam can escape. Don't overdo it. Now put it in the refrigerator and let it refrigerate for 20 minutes. Now after that, preheat your oven to 400 degrees. Place a baking sheet on the rack in the middle of the oven. Take the pie out of the fridge and put it on the baking sheet in the oven and bake it for 20 minutes. Now, After 20 minutes, reduce the heat to 350 degrees and let it bake for another 40 minutes or so, just until the crust is golden brown and the blueberries are all bubbling, right? Then, when that's done, remove it, place it on the stove, just let it cool for 2 to 3 hours. This will allow the blueberry filling to set. When you're ready to serve it, you can eat it just like that, or you can warm it up in the oven, making sure to have plenty of Haagen-Dazs vanilla ice cream on hand to serve with the warm blueberry pie. I mean, come on, it is the 4th of July. This dessert, by the way, should probably cost you $20 all in. And while you might be able to buy it for a little bit less, the fact is you got the dessert and the ice cream, and you did it yourself. And so your guests will be very proud of you, and it'll just be a delicious way to end your 4th of July meal. In any event, it's going to be a gorgeous day here in Florida. It's going to be a gorgeous weekend. I will see you tomorrow, and until then, take good care.